You talked earlier on about the fact that the market needs to understand how the president operates. Do you think that the chair, the Federal Reserve chair, understands? Do you think the Fed understands how the president is operating and as a result just kind of simply ignores the trade issue for now?
I think the Fed does put the trade issue on the back burner, frankly. It's a level of uncertainty. But as I said, if you look at what's actually transpired on the trade side, I think 3 to 6 months ago, the Fed would have said our biggest risk was NAFTA. And now it looks like NAFTA is moving toward a conclusion, some compromises on auto content, et cetera, and really not becoming a major issue. And I think given the Fed's orientation, tariffs that might go into effect 6 months from now, not something they're really going to factor into the decision-making process. I think much more important will be the employment report to see whether wages are picking up. And at the same time, given the dynamics of the timing of inflation last year, we're going to see some pretty significant increases in year-over-year inflation rates reported for the U.S., core inflation rates, over the next, March, April, May, June period. So I think the Fed's looking at that acceleration of core inflation. They'll worry about any trade issues if and when they materialize.
I haven't had this conversation for weeks. Is it 3 or 4 this year?
Yes. I think right. A lot of that, I think 3 is pretty definite. And they'll have to look at what happens to financial conditions, what happens to asset markets, what happens to the trade side. And importantly, we've kind of forgotten, on the fiscal side, things are going to start materializing there over the second half of the year. So, this could go either way. You could have 3 because the economy softens under trade barriers, or you could end up with a solid 4 because, in fact, the economy shows some very good momentum. You look at the all-economy PMI in the U.S. that was released yesterday, so it's a weighted average of the manufacturing and services sector. The 3-month moving average just hit a record high. That data started in 1997. So we're worried about, is the economy softening? Can it withstand Fed rate hikes? We've just had the highest 3 months for that measure of the economy that we've had in the last 20 years. So, I think that March, we've had the March hike, we get a June hike, we get a September hike, and then December will really depend on these things that are more than 6 months out from now.
Bob, the last 24, 48 hours have kind of taught me a number of things, one of which is that the bond market, the gravitational effect of what the Fed is up to at the moment is absolutely massive in terms of the balance sheet, what it's doing in terms of its exit from policy, because we've seen the equity indexes all over the place, indices all over the place, but the bond market hasn't moved. Have we just started to get our arms around understanding just how big an effect this all is?
I think so. I think that the bond market, again, the rallies we saw in the bond market, given the magnitude of the volatility in equities, was really very small. And I think that tells us that the general trend to bond yields is higher, that we're going to see those materialize as we go through the course of the year in line with what the Fed does. So, to say that 10-year Treasury yields might hit 350 by the end of this year, I don't think is a stretch at all.